Over the last few days, something quietly started shifting in the gold market. And if you've been searching for answers about what's happening with gold prices, with the dollar, with central banks, you're not alone. We've taken a few days to dig into what the actual data is showing. And what we found is more interesting than the headlines suggest. This isn't about predicting gold prices. This isn't about telling you to buy or sell anything. This is about understanding what the market is actually signaling right now. And the signal is about something deeper than just gold trading. It's about how physical supply, government debt, and central bank behavior are all pointing in the same direction at the same time. When multiple things point in the same direction simultaneously, that's when you know something structural is happening. So let's break down what's actually going on, because once you understand this, a lot of things that seem confusing suddenly make sense. The starting point is something most people don't think about. There's a difference between the gold price you see and the actual cost of getting gold. This gap exists. It's real. And it's been widening. That's the first signal. The second signal is what central banks are doing. They're accumulating gold, not selling, not trading, accumulating. The third signal is what's happening with US debt and interest rates. The dynamics are creating structural pressure. When you put these three things together, you get a picture of what's really happening in the monetary system right now. And understanding that picture helps you understand your own money, your own savings, and what might happen over the next few years. So let's start with the simplest part. The gold price you see versus the gold price you actually pay. Here's something that seems simple, but is actually really important. There are two different gold prices happening at the same time. The first is the spot price. This is what you see quoted everywhere. It's the price that pops up when you search for gold price. It's maybe $2,100 an ounce or whatever the current number is. That's the theoretical price for immediate delivery of pure gold bullion. It's the reference price for the whole market. But there's a second price. And the second price is what actual buyers are paying when they want physical gold in their hands. And lately, these two prices have been diverging. The difference between the spot price and what you actually pay is called the premium. And this premium has been rising. Historically, the premium on physical gold was tiny, maybe a few dollars per ounce. That's just normal market friction. But if you tried to buy physical gold bars or coins right now, you'd pay significantly more than spot price. How much more depends on what form of gold you want. Coins tend to have higher premiums than bars. Certain purities have higher premiums than others. But across the board, premiums have been rising and staying elevated. This is significant. Why? Because a rising premium tells you something very specific about the market. When physical gold is abundant and easy to find, premiums disappear. People can just buy at spot price. But when physical gold is harder to source, when it's less available, people have to pay extra to get it. That premium is the price of scarcity. It's the market telling you there's more demand for the actual metal than supply can easily meet. This matters because the spot price might tell you one thing, but the physical market is telling you something different. The spot price says gold is one thing, but if you actually try to buy and take delivery, you're paying more. That gap is important. That gap is telling us that something is happening to physical supply. Delivery times have also gotten longer. What used to happen in days or weeks now takes weeks or months for some types of physical gold. If you want allocated bars, allocated coins, certain purities, you might be waiting. The refineries that process gold are running at high capacity. Mining production hasn't increased. In fact, mining output in many regions is declining as ore grades get worse and extraction gets more expensive. So the supply side of physical gold is relatively constrained, and the demand side is clearly strong. When you have strong demand meeting constrained supply, you get premiums, you get waiting periods, you get friction. This friction is real. And it's structural, not temporary. Now, why does this matter beyond just people who want to own physical gold? Because it tells us something about what's happening at a much bigger level. It tells us that institutions, central banks, and smart money are preferring to own actual gold instead of paper claims on gold. And that's where we need to go next, because this preference for physical over paper is the first signal of a bigger shift. Let's zoom out and talk about what central banks are actually doing right now, because their behavior is the key to understanding everything else. For 70 years, since World War II ended, the US dollar has been the world's dominant reserve currency. That means when countries around the world needed to hold emergency reserves, they held dollars. That's been the foundation of everything. But something started to change a few years ago, and it's accelerating right now. Central banks are buying gold, not selling, not trading, buying and holding. China's central bank has been doing this consistently, quarter after quarter, year after year. But it's not just China. Russia is accumulating gold. India is accumulating gold. Other countries that want to reduce their dependence on the dollar are accumulating gold. This is a structural shift. It's a pivot in how central banks think about reserves. Instead of holding primarily dollars, they're diversifying into gold. Now, if you read mainstream financial media, they'll tell you this is normal, just diversification, nothing special. But that's not quite right. This is different. This is deliberate. This is coordinated without being coordinated. Why? Because these central banks are all responding to the same reality. More countries are trading without using the dollar as the middleman. China and India trade in their own currencies. Russia and China do the same. Europe is building payment systems that don't require dollars. This is dollar-neutral trade that happens without the dollar being involved. As more trade becomes dollar-neutral, countries need fewer dollars in their reserves. So what do they buy instead? Gold. Gold is perfect for this because gold is neutral. It doesn't favor any country. It doesn't depend on any government's decisions. Gold is gold. It's valuable in any currency system, in any monetary regime, no matter what happens politically. When a central bank buys gold instead of holding dollars, they're saying, we want to own something that will be valuable no matter what the future holds. This isn't a panic move. This isn't central banks saying the dollar is dying. But it is central banks saying, we don't want to be dependent on the dollar being the dominant reserve forever. We want to hold something that doesn't require anyone's promise. We want something that works in multiple scenarios. This creates a very different kind of demand for gold than what you see from regular investors. Regular investors buy gold because they're worried about inflation. Central banks buy gold because they're thinking about systemic risk. Regular investors might sell when sentiment shifts. Central banks hold, they accumulate, they're not trading. That creates a floor under gold prices, a persistent demand that doesn't go away. Now, here's where this connects to the physical supply problem we just talked about. Central banks want the actual metal, not paper claims, not certificates, the actual gold. So they're buying physical gold. And that's creating demand for the physical metal that's pushing against the constrained supply we discussed. That's why premiums are rising. That's why delivery times are extending. Central banks, wealthy individuals, smart money are all preferring to own the actual metal instead of owning claims on metal. This preference is structural, and it's going to persist as long as the uncertainties persist. Now, what are they uncertain about? What's making central banks want to reduce their dollar holdings? That brings us to the third piece of this puzzle, and this is the piece that explains why they're thinking this way. The United States has a massive national debt, over $30 trillion. That debt grows every year. The government spends more than it takes in. The difference becomes new debt. This is not unique to America, but America's situation is unique because the dollar is the reserve currency. That gives the United States a special advantage. The world wants dollars. So the world buys U.S. Treasury bonds. That keeps borrowing costs low. But that advantage only works if people keep wanting dollars and keep buying Treasury bonds. And here's where the interest rate situation gets complicated. The Federal Reserve is trying to fight inflation by keeping interest rates elevated. Higher rates are supposed to reduce spending and cool down inflation. That's the theory. But higher rates also make the government's debt more expensive to service. When you owe $30 trillion and interest rates go up, your annual interest payments skyrocket. This creates what you might call a structural bind, a trap. The government needs rates to be high to fight inflation, but high rates make the debt burden worse. The government needs rates to be low to manage the debt burden. But low rates don't fight inflation. You can't solve both problems at the same time. You have to choose which one matters more. This is the situation we're in right now, and it's why central banks are thinking about their reserve composition. They're looking at this and thinking, how long can the U.S. government manage this situation? That's not a paranoid thought. That's a legitimate question about debt sustainability. Now, there's a term economists use for this situation, real interest rates. Real interest rates are what you're actually earning in purchasing power terms. It's the interest rate minus inflation. If you earn 4% interest, but inflation is 3%, your real interest rate is 1%. You're earning positive real returns. But if you earn 4% interest and inflation is 5%, your real interest rate is negative 1%. You're losing purchasing power. For most of the last decade, real interest rates have been negative. Savers have been losing money in real terms. This has actually been good for borrowers, particularly for the government. You can borrow money and pay it back with dollars that are worth less due to inflation. That makes borrowing cheaper in real terms. But this only works if inflation stays low or if people believe inflation will stay low. If inflation expectations shift, if people think inflation will be persistent, they demand higher real interest rates. And that's where the trap tightens, because higher real interest rates mean the debt becomes more expensive to service. This is the structural uncertainty that's making central banks want to reduce their dollar holdings. They're looking at a situation where inflation could be persistent, where debt is massive, where interest rates are constrained, and they're thinking, we want to hold something that maintains value in this environment. Gold maintains value in inflationary environments. Gold maintains value when real yields are negative. Gold is the hedge against the scenario where debt dominates monetary policy and purchasing power gets eroded. Central banks understand this. That's why they're accumulating gold. They're essentially holding insurance against the possibility that real purchasing power gets damaged over the next decade. Now let's talk about something that becomes increasingly relevant when you're worried about systemic stress. The difference between owning physical gold and owning a claim on gold. When you buy a gold ETF or a gold futures contract, you're not buying gold. You're buying a contract. That contract says, if you want gold, you can take delivery or you can cash settle and receive the dollar equivalent. But fulfilling that contract depends on the counterparty honoring the agreement. This is called counterparty risk, the risk that the other party won't do what they promised. Historically, counterparty risk on gold contracts has been very low. Major exchanges have strong track records. Institutions are reliable. But counterparty risk is never zero. There are always scenarios where it could matter. If a major financial institution faces stress, they might have difficulty sourcing physical gold to meet delivery demands. If there's a significant run on physical gold, they might not have enough metal to deliver everyone who wants it. This happened during the 2008 financial crisis. Some institutions couldn't immediately deliver on gold claims. So if you're thinking about long-term wealth preservation, if you're concerned about the structural issues we've talked about, the question becomes relevant. Do you want to own the claim on the gold or do you want to own the actual gold? The market is answering this question. And the answer is clear. Institutions are moving toward physical ownership. They'd rather own the metal than own a claim on the metal. This preference is creating the premiums we discussed. The preference for physical gold is pushing against the constrained supply. It's not panic. It's not irrational. It's measured risk management. People are thinking, if there's structural uncertainty about whether institutions will honor their obligations in full, maybe I should own something that doesn't depend on anyone's promise. Gold is that thing. You can hold it. No one can take it away. No one has to promise anything to you. This is why you see central banks moving toward physical. This is why you see premiums rising. This is why you see delivery times extending. The market is telling us that physical gold is becoming more valuable than claims on gold. That's a significant signal about how institutions are thinking about risk and safety in the current environment. So let's look at the full picture of what we've covered. You have a physical gold premium that's rising. Physical gold is becoming harder to source at the quoted price. You have central banks accumulating gold, not selling, accumulating, diversifying away from dollar-dominant reserves. You have a debt and interest rate situation that creates long-term pressure on real purchasing power. You have institutions preferring physical gold to paper claims on gold. These are not four separate phenomena. They're connected. They're all symptoms of the same underlying shift in how the world is thinking about money. The shift is this: confidence in the ability of debt and monetary policy to be managed is declining. Not collapsing, not panicking, but declining at the margins. And that declining confidence is driving people and institutions toward assets that don't depend on promises. Gold is the ultimate such asset. It's why it matters. Now, what does this mean for you if you're a regular American thinking about your own money? First, understand that inflation is real and it's persistent. Your dollar is worth less than it was 5 years ago. That's not debatable. If you're holding cash, earning almost nothing, you're losing purchasing power. That's a real loss. Second, understand that the structure of the global monetary system is adjusting. The dollar's dominance is declining gradually. That adjustment will take years, but it's happening. Third, understand that gold is not an investment in the traditional sense. It's not a stock. It's not a bond. Gold is a store of purchasing power. It's a way to hold wealth that doesn't depend on anyone's promise to honor a claim. Different people will make different choices about whether to hold gold. That depends on your situation, your timeline, your level of concern. But understanding why gold is becoming more important helps you think about your own financial situation more clearly. Do you have some emergency reserves in something real, something that maintains value through inflation? Or is everything you own a claim on someone else's promise? These are the questions becoming relevant in the current environment. Fourth, pay attention to what's actually happening with supply and demand, not just prices. The fact that premiums are rising, delivery times are extending, that central banks are accumulating. These are the signals that matter. Price can move either way in the short term, but supply and demand tell you about structural shifts. Finally, think about real purchasing power instead of just nominal prices. When gold prices go up, that might just mean the dollar is going down. The question isn't whether gold is expensive. The question is whether your dollars are maintaining their ability to buy things. Gold maintains that ability. Paper promises don't always. So here's what we've covered. The gold market is sending signals. The central banks are sending signals. The debt situation is sending signals. They're all pointing in the same direction, toward a world where physical assets matter more than they have in decades. This is not a collapse scenario. This is a structural adjustment. It will take time. It will be gradual. But it's happening. For your own financial thinking, understanding this shift helps you make better decisions about where your wealth sits. Understanding why physical gold matters, why central banks are accumulating, why debt creates structural pressure. This helps you think more clearly about your own situation. If this kind of market breakdown helps you think more clearly about these dynamics, consider subscribing to MarketPulseUSA. We break down what's actually happening in the global financial system so you can understand your own money better.